Imagine checking your brokerage account and seeing $720 in dividend income. Not from trading or timing the market, but simply from owning shares of companies that share their profits with investors. That's the idea behind dividend investing, creating a consistent stream of cash flow from long-term ownership in solid businesses. In this video, we'll look at how dividends work, what kind of portfolio could generate $720 a month, and the math that gets you there. Okay, here I want to talk about what dividends are. A dividend is a portion of a company's profit that is paid to shareholders. When a company, let's say Johnson & Johnson or Pepsi or Home Depot, earns more than it needs to run and grow, it may distribute some of those earnings as dividends. Most US companies, for example, pay dividends every quarter, though there are some ETFs that pay monthly. There's an example that will be coming up here in this video I will share with you soon. And the payments show up as cash in a brokerage account and can be reinvested. It's one of the simplest ways to turn ownership of a company into income. Now, you might ask me, why should I care about dividends? Honestly, dividends appeal to many long-term investors because they provide regular cash flow. Unlike selling shares, which depends on market prices, as you know, dividends are paid regardless of whether the market is up or down, assuming the company maintains its payout structure. Okay, so now, if I want to get $720 per month in dividend payment, I need to multiply that by 12 to get to the annual amount of dividends that I will get. So in this case, $720 per month times 12 months in a year is about $8,640 of annual dividend payment to me. Now, I want you to really think about this part. This is very important. Dividends are really as passive of an income as it gets. You're not lifting a finger. Your money is doing the work for you. I will also say that it is hard to put aside a meaningful amount of money that can generate significant amount of dividends for you. So it's not as easy as everybody makes it sound like, but it is a possible investment strategy. Let's now refine this a little bit further. The math comes down to this relationship. Your investment is equal to annual dividend income divided by dividend yield. Dividend yield is a key concept here that we'll explain here in a second. But essentially, if you take your annual dividend income and divide it by the dividend yield, that gives you the total investment amount that you need to have to get to your target. Okay, let me explain what dividend yield means. Dividend yield represents the percentage of a company's share price paid out in dividends each year. I am showing the S&P 500 high dividend ETF that the share price is right now around $48. If you look here, the 30-day yield is noted as 4.59%. That's always in percentage. So what that means hypothetically is if you have a stock that is $100 and the yield is, let's say, 4.6% for easy math, that means that stock on an annual basis will give $4.6 for that $100 stock. Okay, going back to our main formula, if you have $8,640 annual dividend yield, which basically is that $720 per month, and your rate of return is 3.4%, you need $254,000 in investment to generate that $720 per month of dividend yield. 4%, it means you have to be at $216,000, and at 5%, you need to be at $172,000 investment. In case you were wondering where that 3.4% came from in that first example in the previous slide, that is a blended rate of these four example holdings. Johnson & Johnson at 3.0% approximate yield, Home Depot 2.5%, Pepsi 3.1%, and SVHD ETF at 4.6%. Something very important to note about dividends in general is that it probably is one of the most passive ways to generate income. You really do not have to lift a finger to generate dividends. Something very important to note about dividends is that they are probably one of the most passive avenues of making money. You don't really have to lift a finger, but I also do acknowledge that it is difficult to come up with the initial sum of money to set aside that will then generate dividend income for you. People typically ask, could dividends grow? And the answer is yes. And it's one of the important factors to consider. Many established companies increase their dividends annually or regularly, which can help the income keep up with the inflation over time. That's the other thing you have to keep in mind. Yes, dividend is nice, but also if it doesn't grow with the rate of inflation, then you're not technically getting the same rate of return in 10 years from now as you are in 2025. So as an example, let's say a portfolio yields around 3 to 4%, and those dividends grow at roughly 5 to 6% annually. The income could double in about 12 years. And that's again coming back to this concept of long-term appeal, income that has the potential to grow even without adding new money, just because the company keeps on increasing the annual dividend yield. Now let's look at reinvestment options for dividends. Some investors choose to reinvest their dividends automatically through a dividend reinvestment plan. Each payment buys additional shares, and then that can generate more dividends in the future for you. This is a compounding effect, and it can accelerate portfolio's growth over time, especially if your time horizons are more long term. And as you can see in this diagram, step 1 is to activate your dividend reinvestment plan. Most brokerage accounts have this option that will automatically invest your dividend when they come in by buying the same stock for you. Step 2 is that each dividend payment buys those stocks once it's reinvested. Step 3 is you now have more shares that will generate more dividends for you in the future. And then number 4 is a beautiful compounding effect that will help your portfolio grow over time. And then step 5 is that compounding over a long investment horizon will lead to step 6, which is building a larger portfolio and larger dividends. I do want to highlight the underlying risk that is associated with dividends and any other stocks. Dividends are never guaranteed. Companies may go out of business, or they might change their payout structure. They may decrease the percentage of their dividend distribution, and someone's portfolio might suffer from that. Like everything else in life, diversification matters in the case of building a portfolio of dividends, and typically high yield stocks signal some sort of a higher risk built into them. So it is important to do the research to understand the ramifications of such stocks. Another thing that is very important to understand is that some stocks give 5-7% dividend yield, but when you look at them since inception, their value has gone down enormously. So yes, you might be generating income through dividend, but your underlying stock value has gone down significantly. So one way to look at that scenario is that when you sell the stock, you're going to be at such a big loss that doesn't matter how much dividend you generated, you're still going to be in the red. So very important to consider those aspects of stocks when you look at something like dividends. I've put together a map to summarize what we have talked about so far in this video. The concept of building dividend income is really rooted in patience and consistency. It is less about short-term results and more about a gradual process that involves reinvesting, staying invested, and allowing time to do its work. Whether someone starts with a few $100s or a larger sum, the math remains the same. Yield, growth, and time combine to turn ownership into income potential. I also want to remind you that for someone to get $720 a month in dividends income, that means they have to set aside $254,000 that has a blended yield rate of 3.4%. Obviously, as the yield percentage goes up to 4 and 5%, the sum of money that is required becomes less and less, but you get the idea. You need a lot of money to produce little income per month. I looked at my numbers from last year and I have earned about $484.71 through dividends for the entire year. Not 1 month, but the entire year, which brings my monthly to about $40. So it's really not meaningful, and there's still some amount of money involved to generate that, but that tells you that my own portfolio is not built around generating income through dividends. Okay, that's it for today. Thank you for watching, and be sure to hit subscribe to not miss the next video. See you in the next one.